welcome to the Self-Storage Made Simple podcast. I have been working on my next guest now for a couple of months, somebody that a lot of the people that I know in the self-storage industry have told me I got to get on the podcast. Very lucky to have connected with her a couple months ago and been able to pick her brain about the industry. Anna Saradze-Herdina, Director of Business Development for Talon Invest. So grateful that you found some time to come and join me.
Thank you so much. Yeah, it's been a busy summer, and I think we connected 2 months ago. So happy to finally make this happen.
I know how hard it is sometimes, especially somebody like you who is as busy as you are and doing as much as you are, to carve out some time in your schedule. So I always want to make sure that I express that gratitude because, quite frankly, you're a piece of this puzzle that's wildly important right now. And the whole purpose of the podcast is just give people information and make sure that they understand what's going on in our industry, that they know people in our industry to connect with for certain aspects of what's going on. And finding money right now has been a pinch point for the last year and a half, 2 years. So been very excited. And Talon Invest, of course, for those of you who don't know, if not the most respected, I guess, broker in the industry as far as finding money, certainly right there among the top of the top. So excited to pick your brain a little bit and dig into a little bit of exactly what's going on in the financial markets right now. I always start the podcast the same way, so I'm not going to break that tradition. Self-storage is such a unique industry, and I know it's something that we'll talk about this, your perspective on the industry itself. I'm always fascinated to know how people found themselves in this little niche that we work in.
That is a really good question.
Yeah, I like that better than if you tell me it's a terrible question. You can say that all day. We'll take it.
Look, here's why I think it's a great question, because we all have our own journeys, right? In terms of how we end up where we are. And some career paths are pretty typical. Some are very atypical. And when I think about how I got into storage, if you asked me a decade ago, I don't think I knew what storage even was a decade ago, right? So unconventional from that perspective. I really started in the tech and SaaS industry. And then 8 years ago, I joined this company that was disrupting the storage space. They were providing basically the full service around the storage as well. So the packing and the moving and the storage. And the storage was placed in these very large warehouses, 500,000 square feet, 40-foot ceilings, similar to an Amazon warehouse where you rack and stack. So there are a lot of logistics and tech that went into running that business. And unlike storage, it's heavy, it's intensive from a personnel perspective, right? You have trucks, you employ a lot of people. So quite the opposite of really self-storage at the core and the things we love about storage and the P&L when you look at it, right? And so I had developed a network in the storage industry. I was working more on business development partnership side. And then one day my CEO comes to me and he says, Anna, we really like this real estate play, and we would like to have more visibility within the centers like Main on Main to build a hub and spoke model around the warehouse business, right? So the warehouse is an hour, 2 hours away. Let's get some really great self-storage locations, highly visible, easy access, and we'll build a system around it to kind of support this larger goal of serving an entire MSA. So why don't you go out and find some storage? So bad. And I think back to that, and it's been like 7 years, and I laugh because, and Sam Zell, who I admire and respect, he was the one that said, if you don't know what the barriers to entry are, if you don't know how hard something is, you kind of go into it full force with an open mind and an eagerness, right? That I think after you do certain things, you get a little jaded and they become much harder. And you're like, do I want to take that on? I don't know. So that was my entry. In 2019, we acquired 4 self-storage properties in New York in the boroughs. And that was, again, my entry. And it was also the largest transaction of the year. So really went from like 0 to 60 very quickly. And a lot of lessons learned. So that's how I got into this space, and it's been quite a journey since then.
Yeah, I was going to say you're buying 4 facilities in New York City, and that's not a cheap transaction in any way, shape, or form.
Yeah, and especially when you just learned what cap rates were a year ago.
I
Right?
can
You're
I didn't get into
jumping off
this
a
business.
cliff and assembling an airplane at the same time. But that's precisely it, right? Like this industry has been tremendous. I think for those of us that are in self storage, the thing that you hear over and over again are the people. It's the community, the opportunity. And even when we look at storage just historically, right, looking at talking about capital markets, looking at where storage was in the 90s, stories that I come across that really I find very heartwarming or just really beautiful to hear is the journey that storage itself went through. So when you look back, we have some clients at Talon Invest. Talon Invest has over 4 decades of experience, so they've seen everything. The principals at the firm were like the OG people getting on calls with groups like Mass Mutual, Aegon, CalPERS, when they were just trying to figure out, how do we underwrite for this? How do we invest in this asset class? How do we look at this? So that transformation has been phenomenal. But in the 90s, trying to get a loan, wait, so
Yeah.
you're buying a piece of dirt and you're putting boxes on it, and people are going to move their stuff in, and they'll rent this just monthly? How is that going to work?
That's so
Um, and now what do we see? These beautiful Class A facilities. The facade is gorgeous. It looks like an office building, in high dense markets, strong visibility, and they serve the community. They're very much needed, but the aesthetics of it and the fit on a community basis is really transformed.
I think that's fascinating. It's a road I wanted to go down with you because you and I share a little bit of a heritage. And I say road, I'm going to take us back to Rhode Island where you grew up. I lived there through high school, and you talked about something. So I wonder if you've seen DXD's facility that they built in Bristol. I wonder if you've seen pictures of that.
Actually, I have seen photos. I haven't seen it in person.
I'm going up next week, and I'm going to drive out there just to drive by it because it literally looks like a multifamily residential building. It's the most unbelievable self storage facility I've ever seen.
I mean, it's so I do think there's definitely a place for aesthetics, but at some point, when you speak to developers and you look at the costs, total project costs,
For
and
sure.
where, especially in today's climate,
Yeah.
um, I think there's a lot of sensitivity around how do you maintain a reasonable development cost, because the
100%.
exit is in consideration. So yeah, I do think there's a place for it. And you hear stories of groups where like the city has requirements that you need to put
Yeah.
all,
I would guess
def-
100% that they were required to make it look that way because knowing Corey Sylvester and the team over there, they didn't do that just because you're adding some significant expense.
but it is aesthetically pleasing, and it is nice to see where the asset class, the level that it's reached, right? In many ways, it is the darling of the food groups, right? When you look at returns, on a 10-year basis, it's really outperformed. And I think, unlike some other, we're fortunate that it's a need driven
Yeah.
business. It does, really well when things are great, but it does fine when things are bad, and that's important to keep in mind. We're also fortunate when you think about the levers that we get to pull and push on from a rental rate management perspective, which I hope we'll kind of talk about today, because I'm thinking about what are some headaches and things that have been top of mind lately as we look at capital, whether it's debt or equity placement. The questions that I'm getting that I'm sure a lot of other folks are dealing with and trying to wrap our minds around.
Absolutely want to go down that road because it's really the big question that's going on in the industry right now, right? With the big REITs playing the game with uh, customer facing rates versus what the reality is of what they might be achieved rates versus
Achieving.
what we're
Mhm.
seeing for web rates. And obviously for me as somebody who's trying to develop ground up projects, it becomes a great game, right? Because you got to, if you're going to the bank and
Mhm.
the web rate is saying $80 for a 10 by 10, but they might be achieving $200 for a 10 by 10. So how do you play that game? I'm more than happy to go down that road with you.
Yeah, going back to kind of the trajectory of this asset class, and I think about conversations I was having like 6 years ago, even like 3 years ago. There's a lot of educating, that takes place, whether you're dealing with, a local bank, a regional bank, or an institutional investor. The understanding of it is a very nuanced business. The intricacies of it are important to note, but to understand how it's structured is critical in terms of how you analyze it and how you underwrite for it, right? So those questions are, we can change rates on a daily basis, but we're not really a hotel business because we have monthly leases. But we're also
Right.
not, triple net industrial where, you have 20, 30-year leases. So
Right.
how do you analyze this business that's very different from all the rest in that respect? And you're right that asking and street rates are very different from achieved rates. And it's understanding when you're especially for developments, you're so correct in saying that when you're looking at a project and that's going to come out of the ground in your 12 to 16 months or so, you're really looking at today's rates and you're saying, okay, where are we going to start? And where are we going to be in year 4 or 5 after it opens, right? After CFO, where are we going to get to? And do you have a good understanding of the various ways that you'll achieve those ECRIs, so existing customer rate increases? I used a really cheesy line recently. Hopefully, you won't judge me for this, but I was speaking with an institutional investor, and the question was like, "Hey, help us get comfortable with rates. Like, we're looking at this, we're putting in our model, and we're just not able to kind of bridge that gap." And I said, if you're just looking at the asking street rates, it's like looking at an iceberg and saying it's as big as just its tip, right? but but that resonated, right? It made sense. So, what we're seeing that the REITs are doing with that, 30 to 50% in month 4 or 5.
Yeah.
And Green Street recently released this in their report, I think at the end of June, or actually maybe a bit later, but ECRIs continue to remain the lifeline. And it's important to be comfortable with that, to know how it works on a market basis, right? We're a very micro market industry. And so you can't take this like blanket approach. It's again, very specific to the region you're in, what you're seeing. But when you're hitting customers with, a 30 to 50% rate increase in month 4 or 5, you can very quickly see that, yes, you can start at $80 and by year 4 get to 200.
Yeah. I know people, that have rented storage in the last year and a half, 2 years, that have gone from $80 to 240 in certain markets themselves personally. One of the things I find fascinating here, and going back, I got into this industry in 2021. So I'm really new. I was in it at the peak, right? I came in when everyone was like crazy gung ho, and street rates and web rates were through the roof because we were still in the middle of the COVID boom. One of the things I've seen now as we're into 2024 that's been interesting to me is the REITs are much more willing for the facilities they own to give more information than they would a year and a half, 2, 3 years ago. I think they understand that for us as developers, if they aren't willing to share a little bit more, we have no way of building something. Because like you said, if you're going to go raise equity or you're going to go get a bank loan, you've got to convince them
Mm-hmm.
of why that project's going to make sense. And at $80 for a 10 by 10, if you're making $10 a square foot a year in a 100,000 square foot facility, you're going to lose millions of dollars, right? You can't even begin to think about doing that development. So it's been an interesting thing. And it goes to a greater point, which is something that you talked about earlier, kind of that idea. And this is something I've talked about with like Mike Burnham from Storage Mart and Mitch Feldman and Tony Artizzoni, who are two of the OG
Mm-hmm.
developers. Why, and I'll ask them, why is this industry so kind? Why are people so nice to each other? And it goes back to something you said, which is they had to be, in order to get to where they are because it was a nascent industry and they had to go find money. They had to share information with each other or they couldn't make it.
Yeah. We are pretty fragmented, right? When you look at, and because of how ECRIs work, a lot of that data, what you're seeing on the web is not an accurate reflection of what's actually happening behind closed doors, right? So we are fragmented. We're still, we're becoming more sophisticated for sure. And there are platforms and third party management and REITs that are doing amazing things. There's a lot of data being collected, but historically, when you think about how it all got started and how you're thinking about adjusting and growing, that data is not easily accessible.
No.
Till this day, it's not, right? So there is an aspect of kind of teaming up and identifying what's what. The analysis is more critical than ever, right? It's digging in, and I would say back when interest rates were zero, when you had interest rate, when the cost of capital was essentially free, it was really easy to have these home runs.
Yeah.
But with the changes, and there's a really great memo Oaktree came out with. It's called Sea Change. But when things like this change, it's harder to make deals pencil. But really, what that means is you have to be smarter. They're not all going to be wins. So, is the market really? I think there's a lot of negativity around the difficulties that we're facing in today's climate and the market. But is it also kind of a resetting, a recalibration of being more strategic, of being wiser in how you look at things and what you're investing in? And I would say yes, that's definitely an aspect of it. Somebody the other day said investors that are putting in like equity or signing up deals, you get a pat on the back if that deal works out to be fine, but if it doesn't, you get fired. And that's kind of the climate that we're in, right? And so I do think the pendulum swings drastically in the opposite direction, where I do come across opportunities and deals where I have a high conviction that this is a good opportunity, good investment. But either if the group was burned or they're skittish or pencils down, a lot of great opportunities are being passed upon. And that's the sad side of when the pendulum swings drastically in the opposite direction. There was a really good quote that I read recently. It was, opportunities are like a sunrise. If you wait too long, you'll miss it. And not to get too cheesy, but how do you identify the right opportunities and make that investment before you miss out? And so there are groups that I think have a better sense of what's coming down the pipe, how they're looking at the market. For example, new supply. We had peak of new supply in 2018, 2019. Now you're looking at some of these markets and percentage of net rentable square feet that were coming down the pipeline were in the teens. Some of these markets now are in like the low single digits. So it went from like 13, 15% of existing supply is going to be delivered. Now it's like, 2 to 3%. So we go in these cycles as long as the fundamentals of a market check the boxes, and this as a developer and the things you look for. If those components are sound and you're not dealing with new supply risk, you're going to be in a pretty good place. I would still say till this day, new supply continues to be, the biggest risk when you're looking at markets.
100% agree. Was just having that conversation earlier today with Tony Artizzoni, who I was talking about, and a gent from Extra Space, where our biggest competitor is new supply, right? And so that's been the big. I have another friend, a developer, Jason Kanan with Nuvo, who he's always fond of saying we're all victims of our most recent deal. And you made me think about what you're talking about, because there's a lot of fear and trepidation in the market just because of people that penciled deals in 2021, early 2022, when, like you said, the prime rate was zero. So you could go get a construction loan, the highest cost loan you're ever going to get, for 5-6%. I knew plenty of guys that were getting non-recourse construction loans at that time. And
Mhm.
all of a sudden, by the time you get out of the ground in late 2022, early 23, if you even could get out of the ground, you're looking at 8-9% on a construction loan, if not even worse. So there's definitely some people that are, I guess, dealing from maybe a place of shock.
Absolutely. Yeah. From a structuring perspective, the silver lining is that there are certainly groups that are getting creative in how they're, structuring terms and what you're getting. The important thing at the end of the day, and this is again like the value in having a group like Talon Invest, when things are great and it's easy to get attractive terms, sure, but if you're not working to kind of continuously build a process to drive a competitive market, to really identify what the best terms that are available to you, you're kind of doing yourself a disservice. So it's interesting being on the forefront, right, and the front lines. This is a These are like live daily discussions. It's a moving target. There's data and news that come out, and it's very easy to kind of jump around and get excited by it. But at the end, it's having real-time information, making the best decisions. And the best way to do that is to have a good grasp on the market and to have exposure to more than just like one or two opportunities, right? You're not just looking, and that is the unfortunate thing of what happened. A lot of these local regional banks that some of these groups were dependent on, their buckets filled up. And, it was easy to have those relationships at the time, but when things became constrained, now you have to turn to other resources in order to, get the capital that you need. So there was a lot of reshuffling, and it's again, I think, important to kind of stay ahead of how you're looking at your growth plan, whether you have all the pieces lined up. And are you looking at all the available resources to make the best decision for your needs in terms of what's available?
So I'm going to dig in a little bit now to Talinvest and kind of have you take me through a little bit of what you guys offer. Somebody that's a developer and they're looking to find capital for a project. What are the different avenues that are available for people, and what is it that Talinvest brings to the table for someone?
Good question. um, if you asked me like 3 years ago, I came from the tech SaaS side, got into acquisitions, was in acquisition for years, and now I'm in the capital side of the business. And again, maybe like 2 years ago, I'm relatively new to the capital side. I'm certainly not new to storage. I think what makes Talinvest unique is the way we're structured. It's not a typical brokerage, first and foremost. I think that's important to convey. There's a team collaboration, and there's really a meeting of the minds. We get together twice a week just to collaborate and talk about what we're seeing in the market. And when we work on a deal, it's not just like two people that are kind of running point. You get a team of 5 people, kind of across different capabilities and skill sets that are teaming up to not just, put together the analysis, the underwriting, the package, but then we have relationship managers who are going to market, working, with various lenders to put that together. We have a closing person that ensures not just, once we get the terms, that it's actually executed and then stays there to ensure that everything's running smoothly even after closing. So that, I would say, is pretty unique. There's, a lot of thought leadership, and internally from a cultural perspective, it's unique, not like a typical brokerage from that perspective. In terms of, I think, what you're getting with us, first and foremost, we place more storage debt than any other group. The experience that the principals have, even prior, so Talinvest, I think we're going on to year 15, but they've negotiated, $12 billion of capital. That's across like 1,500 properties. When you think about the scale and experience. So there's some really deep rooted relationships. The understanding of storage is probably better than, anyone that you're going to get. We really know what to focus on and how to help our clients um, look at the investment and help them achieve their goals. But yeah, from a development specifically, it's really hard right now. So when I meet with clients, we talk about, it's really understanding, what are your objectives? Like, what's motivating you? What's important to you? You start with that first and foremost. And then from there, you kind of piece together, based on your project, what you're working on, what market it's in, what are going to be the best options for you? So, you mentioned, for example, non-recourse versus recourse. It just totally depends. And so it's not a one size fits all. It's very much tailored and structured to first identifying what it is that you want to get out of it, and then what are going to be the best options to help you get there.
Crazy as it sounds, I always try and keep this to 30 minutes, and we're coming up on 30 minutes very quickly. But there's one more question I wanted to ask you before we start to wrap up. You got into storage like 7, 8 years ago, and you've really been in it for an interesting cross section of the asset class, right? You talked about 18, 19 being like the highest deliverables in the history of the industry. Then we had COVID, which of course, pandemic for the world, but for storage was this unbelievable ride where it was like nothing maybe any asset class has ever seen. And then we get the interest rate hikes in 22, and now we're in a totally. So I want you to kind of take me through your journey and what you've seen from then until now in the storage space.
I think to summarize it in a nutshell is, don't get too excited. What I mean by that is the fundamentals of what make important or what make great investments, the fundamentals of that. Having a good kind of historical perspective and having a realistic perspective is really important. You just talked about lots of highs and lots of lows, right? And when we saw people get into the space at the height, the golden hour, where like you really couldn't fail because you couldn't bump rates any higher. There was so much capital. It was easily accessible. It was like all the things that lined up. I think it's important to kind of stay grounded and how you assess opportunities and what it is that you're investing and how you're growing that strategy. That's for me, like in a nutshell, like I guess to also be surprised, certain markets that people didn't think were going to do well actually ended up performing fine. Maybe like the density wasn't there. In a 3-mile radius, you had 30,000 people, but household income was really high. So seeing the kind of the process, I think the groups that really suffered were groups that came in really, hot and eager. They took that moment in time as an indication that this is what it's like and this is what it's always going to be like, without kind of seeing the historical experience of like the ups and downs, right? So like the 08, 09. And so, yeah, I think the takeaway in the past 7 to 8 years is just keep calm, look at the fundamentals, and make smart decisions. And I know that's pretty simple, but I think people get carried away, whether it's for the better or for the worse, right? Like I mentioned, the pendulum swings. And so if things are going great, good, okay, but still make smart decisions. And if things are kind of tough right now, do the fundamentals of what make it a great investment, are they still there? If so, then move forward. But yeah, I'm not a person that really looks at things from an extreme perspective. It's just being level-headed and grounded through the ups and downs. And that's really, when you look at the people I think we look up to who have done really well in this space, have been steady and consistent with how they approach things.
Absolutely love that. One of my first mentors in real estate used to always tell me, Thad, get off the roller coaster and stay on the platform and just watch it go. Right. So really, really cool idea. I'm still working on that. I haven't mastered it yet. I'm still working on it. I am going to call my buddy Shimon Cantor after I'm done with you, Anna. He's the one
Sure.
that urged me to reach out to you and get you on the podcast. And he was 100% right. Been such a pleasure to
Thank
get
you.
this knowledge and very easy to talk to too, which is awesome. Your personality shines
Thank
through when
you.
we talk, which I appreciate and love. Tell me how someone gets a hold of you. Somebody wants to reach out to Talon Invest. Maybe they have some projects they're looking for equity for. What's the quickest way for them to touch base with you?
Yeah, so if you go to talonvest.com or look me up on LinkedIn, but yeah, the phone number is on the website and I'm on LinkedIn. So feel free to look me up and message me. And then in terms of Vegas, are you going for
I
the
am
SSA?
absolutely going. Tuesday, Wednesday, Thursday, I'll be there. I get
I'm,
midday Tuesday, leave midday Thursday. We'll definitely make sure we get it face to face.
I'm really excited for that. So yeah, hopefully I'll see you in person here shortly. And yeah, I thank you for your time. Hope you have,
Thank
a
you
good
for
rest
your
of your
time.
week. And wait, you're also training for a marathon, right? Did I
And
see that?
11.2 miles yesterday. This will be my first week in my training. I think I'm like 20 weeks in that I'll hit 26.2 miles for the week. So I'm quickly getting to that place where it's actually realistic to think I might finish this marathon.
This is exciting. We should get a pool going to see where you end up.
Love it, love
We'll
it.
get Shim into bid as well.
So appreciate your time. That's it for this week's episode of the Self Storage Made Simple podcast. Listen, if you, as I always say, if you got something of value, click the like button, subscribe to the channel so you get updates on future episodes. Anna Saradze Herdina, thank you so much for spending your time and giving us your amazing knowledge.
Thank you. Pleasure to be here.